a problem. If we enter at the close of the engulfing bar, we lose the reward to risk advantage because the stop loss becomes too large compared to the target, reducing the setup to less than a 2-to-1 reward to risk ratio. So, what should we do in this situation? The solution is very simple. Instead of entering at the close of the engulfing candle, we place a limit order at the midpoint of the bullish engulfing pattern. The stop loss is placed below the demand zone, and the target is set at the next key resistance level. This type of entry allows us to reduce the size of the stop loss while keeping the same target, which dramatically improves the reward to risk ratio. And look at what happened next. The market retraced back into the limit order, activated the trade, and then rallied strongly upward until it reached the target exactly as expected. Now look at another chart example. This is the Canadian dollar versus the Swiss franc on the daily chart. As you can see, the market is clearly trending downward, which means we want to focus only on high probability selling opportunities in the direction of the trend. Now here we have a clear bearish institutional zone, also known as a supply zone. So let's evaluate the quality of this setup. First, the zone is fresh, meaning price has not returned to it since the strong bearish move was created. Second, the candles that formed the move are large and aggressive, showing strong selling momentum. And third, the previous support level was broken with momentum, confirming that sellers were in control of the market. All of these factors increase the probability of the supply zone working. Now, before taking any trade, we also need to evaluate the reward to risk ratio. And as you can see, this setup provides at least a 2-to-1 reward to risk ratio, which already makes it a valid swing trading opportunity. Now let's look at what happened next. The market retraced back toward the supply zone, and once price reached the area, it reacted aggressively and formed a clear doji candlestick pattern. This strong rejection tells us that selling pressure was already present inside the zone and that institutional limit orders were likely waiting there. Now here is an important lesson. If we place the entry directly at the close of the doji candle, with the stop loss above the zone and the target at the next support level, the reward to risk ratio becomes poor and drops below 2-to-1. So what should we do in this situation? The solution is simple. Instead of entering at the close of the doji candle, we place a limit order at the midpoint of the doji candle. The stop loss is placed above the supply zone, and the target remains at the next key support level. This technique allows us to enter the trade at a better price, reduce the stop loss size, and dramatically improve the reward to risk ratio. And now, instead of less than 2-to-1, the setup provides approximately a 3-to-1 reward to risk ratio. Now look at what happened next. The market retraced back into the limit order.